The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. And joining us now here as we're spending time at the Farm Progress Show, just talked to him a few weeks ago and happy to sit down and have another conversation with him talking about the markets, the grains and oilseeds in particular. Steve Nicholson with Rabobank joins us. Steve, it is good to see you in person this time, sir. How are you?
Good, Jesse. It is great to see you in person. This is much better than through a
video feed or a phone call or whatever the case is. Exactly. No, this is what I love about a farm show is I get to see the folks that I talk with or talk to every day, and that's just what makes it fun coming to these events.
It's fun to come to farm because you see old friends, you see people you haven't seen for at least a year, if maybe not longer, and so this is one of the great things about farm shows. I agree.
Absolutely. So I want to start. A few weeks ago, we talked about some of the downturn in the grain markets and some of the overall bearishness.
Yeah.
Well, I feel like it's kind of accelerated in the last month since we talked. I mean, we've set new contract lows in corn, in wheat, soybeans. I mean, we've lost about $1.50 in beans futures, I feel like. So, I mean, in your mind, has anything changed with your mindset surrounding the markets here just in the last couple of weeks?
No, it's a little discouraging because you've seen the market continue to sell off, and you're like, can we find a bottom? And it almost the answer to that is it seems like the market can't find a bottom. But, overall, I wouldn't say that my mindset's changed and that the market we're poised for a rally or a move up. And I hate to say that, but I think we have to be realistic as where we are today. Mm-hmm. So a couple things that is a little different, prices, low prices cure low prices in the sense of we're starting to see a little pickup in exports. The corn exports continue to be very good, and I think we have to let's be thankful for that. I think the other thing is that the good news is we got the USDA data, which is basically the bad news as well. But it also reinforced our view that this was a very big crop, and that crop is there. But I will say, just in the last week or so, talking to producers, doing some traveling, and thinking about where that corn yield is, wondering if USDA is going to trim that as we go forward, based on the fact that you go north of Highway 20 in Iowa, south of I-90 in Minnesota. That area was pretty wet early on, had a lot of washouts. You've got a lot of holes in fields. That's going to show, a situation where the yields are maybe not quite as high as we thought. So I think that's the one thing I would say on the corn side. We have a possibility to see a little bit of downdraft in the yields. But the fact is, we're going into this. We still have a lot of bushels in the bins, and we're going to add on top of that because we got a big crop coming that needs to be harvested.
I've seen a lot of folks talking about this on social media, and I've heard this in some conversations as well. And, I think about this, of course, the risk of trading futures and options could be substantial. I got to get that out of the way here. And I know, you may not be able to give specific recommendations here, but I know there are a lot of folks who are, they're wondering, what do I do? And they maybe feel like that the person they work with, is not giving them all the options, so to speak.
Sure.
I think there's some folks that they maybe never really done a lot with the futures and options market, for instance, and things like that. And so they're really sitting here going, I don't know what to do. I have not marketed near enough grain, and I feel like I am very stuck right now. Are you hearing some of the same, Steve?
Oh, absolutely. I think that's a good way to characterize it. And we're getting a lot of those questions, which always makes you nervous that there is a lot of corn behind them that they got to move. So what do you do? I mean, that's, I think people have gotten paralyzed here. I think some people are waiting for the fall rally. So let's talk about that for a minute. So, in the past when we've had a fall rally is because we had a short ending stocks or stock situation. We don't have that now. You've got 2 billion bushel corn carryover. You've got a soybean yield or soybean ending stocks globally that's been growing, both because of Brazil and because of us. And now you got a big bean crop, and so you're going to grow that supply. So the market's like, I don't need to bid the price up because I've got plenty of supply. Now they may need to bid basis up to try to get pulled out of the country, but that's a different discussion. So I think there's a couple things to think about. everyone's talking about the higher interest rates, and so if you store that grain and carry it, it's more expensive now because you have higher interest rates. Now, the board is also showing you a carry, so you need to understand what is your cost to carry and what will the board, can you make money storing that grain, and you have to do that math. But if you do the math, you also have to execute on the back end to sell that, sell that carry, rather than say, oh yeah, it's carry, but you have to execute against it, because by the time you get there in a carry market, that grain, that price is going to go down and you're going to lose the carry. So there's one thing to think about. The other thing is when you think about a bin, it's basically money in the bin. So what's that money worth today? Well, you could look at it a couple different ways. If you sell the crop, you can take the money and you can put it in a bank for 5%. You can find a 5% return on that money. So that's one thing. So you have to think about the opportunity cost this year. And what we've seen, of course, and you mentioned it right at the top of the question, is you've seen grain prices continue to depreciate. If you'd sold it, whether it's today or 2 months ago, you could put that money back and it's not depreciating anymore. So you have to think about that opportunity cost as well. One of the last things I would say is, if your mindset is that we are going to see a market rally, and I'm not saying that's right, wrong, or indifferent, is that, that's what the board is. You can buy the board back if you sell the physical, or, you can buy options, buy call, and wait for the appreciation of the call. So you've got some opportunities or some alternatives there to just continue to hang on the grain, hoping that it will go forward. So hope doesn't make a market go up.
No, it does not. And something else, too, that I think on the totally opposite side of the spectrum here that I've maybe noticed a little bit of is that someone who has been trying to play the carry in the market, but they have kicked the can down the road on the carry over and over and over again now, and that's not helping the overall situation either. I think about this, too. I mean, September options expire this week. So, I mean, we've kicked this can so far in some cases, so you have some folks on one side who haven't done enough and others who continually kick the can down the road, and that's not good for the overall market either.
No, because you two things are, you're raising your cost as you roll that. There's a cost to doing that for you, and then also you're just keeping that grain, if you have it on the marketplace, and there's that cloud, as I always say, it's sort of the cloud of grain hanging over the market, because the market knows it's out there. And the market's not going to bid up unless it absolutely has to get it, and it hasn't had to do that. So we say all this and we talk this discussion. I'm not saying this is easy, and I'm also not saying this is a difficult position to be in. And I guess the one frustration is we've seen this movie before. Let's learn something from it and move forward from there.
I think, too, the big thing that I'm concerned about in watching is that we have inputs, equipment, everything has gotten to these exorbitant levels here, and now commodity prices have come down, and we know that, commodity prices are the first thing to come down. Everything else takes a while, but it's just now that wide discrepancy between all those things. Making decisions for 2025, I know that's more of a concern than it is necessarily this year's marketing.
And one thing you touched on, I think, is really important. The costs have gone up, and in that in that asset or whatever you're buying, you have more money at risk than ever before. So you have to be much more diligent about understanding that what your financial situation is. I hate to say every day, but you almost have to have a running total to know what's going on every single day, because you have so much capital at risk. But you're right. It's going to take a while for input costs, whether it's land rent, whether it's machinery, whether it's seed, whether it's fertilizer or chemistry, to come down to get that parity with where the market is today. And we've seen this movie before. You do see adjustments, but it does take an awful long time to get there, and that adjustment's very tough. But I think 25, we're going to see an adjustment. It won't be for everything we need. But the other thing I've talked about and kind of noodled around in my brain is talking about the farmer's going to spend X number of dollars come late this fall, early winter, buying seed and fertilizer and chemistry, and maybe he has to buy a new grain bin, or he has to do something to machinery. So he has all this cost in that crop, and he hasn't planted it yet. And so you have all this money outlaid, but you haven't done anything on the revenue side. It's the classic Texas hedge. You're holding out one leg that's dangling out there with no risk underneath it. And I've kind of tried to domesticate this argument a little bit and think about, well, maybe it's time, once you get some of those costs bought, like a hog crusher, like a soybean crusher, as soon as you buy, or an elevator, as soon as you buy the grain, you go out there and you hedge it to hedge the risk. And why not do that on the farm as well? At least hedge get the money cost out, get the money equaled up so that you could pay the bill. And then if you have money left over, which we hope you do, then you can, there's your gravy to market against it. So I think there's a lot of things that that we have to think about. We have to, we're all creatures of habit, and I know I have to think about things different, and that's hard. I mean, it's hard, and I get it.
It's very, very true. Very true. Steve, real quick, 30 seconds. Final thoughts you want to reiterate to folks here today?
Again, reward rallies in this market because you may not get very many of them. And, be taking advantage of some of the opportunities that you're going to see on the input side. Your bank's going to have a certain interest rate, but don't forget about your input supplier because they're going to have bargains out there this year because they need to move product as well. Don't forget them.
Appreciate the time. Steve Nicholson, Global Sector Strategist for Grains and Oilseeds with Rabobank. Steve, it's good to see you here at the Farm Progress Show.
Thanks for having me, Jesse. Good to see you.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.